Welcome to the Daily Update, where I'll go over the action in the market for Friday, November 17th, and then we'll see how things look for Monday, November 20th. Talk about a sleepy day. Boy, we just were in a really narrow range for the trading day. Volume really dropped to below average, and we're kind of getting a little bit of a head start in the pre-holiday mode. We're still hanging in there positive. We're not seeing a lot of selling into strength, at least yet, with the mega caps and the S&P is holding up okay. We're seeing a little bit of an improvement in the broad market, and we'll go through and talk about that. So let's go back and talk about what happened. Right at the open, we had a flat open, and prices were in a very narrow range between the unchanged level and the daily pivot at 45.03. As the day went on, we rose up to R1 at 45.18, and then we fell back down to the unchanged level, which acted as support on an up day, and we ended up closing slightly positive. We were up 0.13% on below average volume, which is strange because it was also options expiration day. Usually just because of that, we see above average volume, but that didn't happen in Friday's session. We are still positive in the short, intermediate, and long term, but we're still looking extended to the upside in the short and intermediate term, where we remain just flat out positive. In the long term, it's about inflation, interest rates, and then, of course, geopolitical events. We didn't see a lot of pre-weekend hedging this time, and that's helping the equity put call ratio to kind of come more in line with what we're seeing in the market right now. So what are some comments that we can make? We're still above 4,500. Not a big technical level. It's more of a psychological level, but we're still above that, at least for right now. Small and mid caps, they outperformed, while the mega caps, they held up okay, but they did underperform the small caps. We've seen some really big updates for the small caps and mid caps, only to give a lot of that back. Well, it was kind of encouraging to see them show improvement in Friday's session. Oil did go up, and that could have produced some headwinds for stocks. We really shot up to $76 per barrel. And then our short-term list is still quite long, with the 20-period exponential moving average, the Stochk RSI, the Williams percent R, both the CCI 14 and 20, as well as the stochastics, the shorter-term RSI based on 9 periods, the boom indicator, and then our slope oscillator. When we switch over to the intermediate term, we still have a pretty long list with the balance of power, the CMB composite, the PMO studies, the money flow index, the vortex. It's getting even a little more extreme there. The TTM squeeze, and now a new addition was the McClellan oscillator based on the S&P 500. And then we've been seeing this for a couple of days now, the bullish percent index for the NASDAQ 100. We're still going through the same basic scenario that the Fed is keeping rates higher for longer. The economic reports seem to be more market friendly, so the market isn't really freaked out that they're too strong or too weak, at least at this point. The idea is that maybe the Fed is done raising interest rates, and then at some point in the future, the market is liking this idea that they will possibly start cutting rates, but that's going to be well into 2024. Geopolitically, we're keeping an eye on Israel, what's happening with oil, and then earnings as they are released. The dollar was down and interest rates were pretty much unchanged. It was just a really quiet day. We do have another addition again. The 10 to the 5 has gone back to being inverted, as well as the 10 to the 2-year and the 10 to the 3-month. We are getting more positive now with sentiment. Now, we can go with this. When we get extreme positive or negative, that's when we look at it as a contrary indicator. But as it's starting out negative and then showing improvement, we can kind of go along with that for right now. We're at 58, where we had ticked up from 55. Nothing has really changed with our trend. We're still positive. The green line's on top. The ADX is above its moving average, and both are above 20. Our bias continues to be positive. That's the 1-day look. And then the momentum is the last number of days taken together. That is also positive. The economic reports that came out, we had total housing starts, which came in up 1.9% month over month, which this tends to be a leading indicator. They're starting to build houses, so that could be good for the economy. On a year-over-year basis, though, we're still down 4.9%. If you look at this on a seasonally adjusted annual rate, that's 1.372 million, a little bit more than the 1.365 million they had expected. Building permits, also another leading indicator, were up 1.1% month over month. but they're also declining on a year-over-year basis to minus 4.4%. That adjusts out to an annual rate of 1.487 million, a little bit more than the 1.44 million they had expected. Here are some charts showing housing starts and building permits. The blue line are housing starts, and this is the year-over-year look. And so we are showing a decline. Actually, this is the month-over-month look, where we're showing a bit of an improvement with the building permits. So these are people that are just getting ready to start building houses. Then here is a look showing that we did tick up just a little bit here with the housing starts. We're at 4.44%, virtually unchanged with the 10-year yield, but that's still above the 4.02% that can bite into corporate profits. Here's our intraday chart. Look at this. It's almost like a flatline EKG where we had a flat open and we just danced between the unchanged level and the daily pivot for quite a while. Then we broke up a little bit higher. We got a little bit above R1. We stayed up in that area before coming back down and then closing slightly positive and a little bit below R1. Here's the intraday chart where it was pretty much flat. We did see a little bit more strength in the pre-market session, but then that was given back after the market opened and we were pretty much flat. As things ended up closing for the weekend, they will resume trading again Sunday afternoon or evening, depending whether you're on the West Coast or the East Coast. Looking at growth of value, they were both up slightly, with value being a little bit stronger than growth. And intraday, we're seeing a little bit of weakness here, and that's a little bit of a concern. When we were going down, we saw the growth to value ratio going up. Now that the market's been hanging in there, we're seeing this ratio really going down. So we want to be aware of that. Some end of day charts, growth was unchanged on the day where value was up. It underperformed with the mid caps as well as the small caps, even though all the other areas ended up being positive. This middle area are the ETFs that go with these different areas of the market. On an end of day basis here for the S&P growth to value ratio, we are declining. We're in a longer term uptrend, but we want to see this going up. Keeping an eye on our trend, we're still positive. The ADX is above the moving average. That suggests that it's getting stronger. The green line was pretty much flat, but it's still on top, and the red line is still down below. There's the short-term chart also suggesting that the short term is also positive. And we're kind of coming back down to this midpoint here with volume overall. We've seen a number of below average volume days, and that was quite surprising to have Friday below average. Keeping an eye on sentiment, we want to know, how's the market feeling? Excuse me, how's the market feeling? And when they're happy, then we tend to be happy too. It's just when they get too happy or too sad, that's when we use it as a contrary indicator. But we're wondering where we're at. We're coming more into the middle part of the month of November now, where we could see a decline in the VIX, but at the same time, there are times when it spikes back up. The Ulcer Index continues to fall. This is another sentiment gauge where we were pretty much flat, but we're below the moving average, even though it did decline slightly. And the VIX with the line chart as well as the bar chart, they both declined. They're well below 20. They're also below their moving averages, suggesting that according to this, there's not a lot of fear in the market. And we're seeing volatility really starting to go sideways. It actually declined on the line chart. So and this is kind of strange, ahead of a weekend with big geopolitical things. Perhaps maybe the situation in Israel is kind of leaving the main news cycle, and so people aren't as focused on that. When we look at the VIX to VVIX ratio, it is going down, and this could be longer term positive. And we're also turning down with the VIX to the 3-month average of the VIX. That's also longer term positive. The VIX to the move ratio, actually, it ticked down just a little bit. You can barely see it here, but it did really decline in Thursday's session, but it's still showing that stocks are less volatile than bonds right now. And I wanted to bring this up. I don't show it very often. I usually just show this in the deep dive video, but we're getting a reading from the SKU index. With the VIX, we measure things with at the money options, where the SKU index looks at out of the money options. And when this spikes up, that means the market is expecting some kind of a big move. We just don't really know what that move's going to be, because sometimes when it spikes up and comes down, that meant a continuation. Other times it marked a top. Other times it actually marked a bottom. So we'll have to see how this ends up playing out. Just be aware of that. The market is expecting something according to this chart. The equity put call ratio did decline, which is kind of surprising. The last couple of Fridays, we've seen this really spike up ahead of a weekend to hedge positions. And the 5-period moving average of the equity put call ratio is continuing to decline. So possibly we set in a spike here. As this continues to go down, that will be positive for stocks. Here's a longer term look at that same chart where we dropped below this extreme level and we continue to fall. But we haven't turned down yet with our longer term equity put call ratio. It's trying to roll over a little bit, and you can barely see it there, but we want to see it more pronounced, where we can notice it by looking at a chart that's longer. This fear gauge continues to decline, showing that fear is coming out of the market. And I've changed this one up a little bit. I tried to take out that huge spike from the COVID plunge just to kind of make it a little more pronounced with the movement on this other fear gauge. It ticked up just a little bit in Friday's session. We did go up a little bit again with our risk on to risk off ratio. That's showing some improvement, but longer term, we continue to decline. We want to keep an eye on this one. Our advanced decline line studies, we're still above the moving average based on price. We're ticking just barely above the moving average based on volume. And we're seeing a real drop off in the new highs, which is causing our 5-period to roll over, but it's still positive. Our 10-period is starting to flatten out here. And it's not that we're seeing a real expansion of new lows. We're not really seeing any. It's that the new highs are starting to drop off because we were in such a tight range. The advanced decline ratio is positive with both the blue line and the red line. They're both above 0. Accumulation distribution. This is what we try to look at for the smart money and try to gauge what they're doing. We're above an advancing moving average. That is looking healthy still. And the chicken money flow saw a really big spike up. So this is also a smart money gauge. And with this going up, that is looking more positive. The NYSE cumulative advanced decline line did show some improvement. We're coming right back up to the underside of this trend line, which I keep saying I'm going to extend it, and then we have a down day, and it kind of goes away. We're showing some improvement here with our regular advanced decline line as we continue to be above this declining trend line. Our other NYSE advanced decline line study, we're right in between the two moving averages and showing a little bit of an improvement, but we're still in a longer-term downtrend with the NYSE advanced decline line. Looking at our other advanced decline line studies, we're coming above the moving average with the NYSE common stock, showing some improvement with the S&P, the mid caps, and the small caps are showing improvement, but they're still underneath the moving average. Our short-term chart, we're still having a really difficult time at this pivot point. We just hit that and just stalled out for the last couple of days. And then on the bottom, we can see where volume really dropped to below average. We're still extreme positive with the 20-period exponential moving average. We turned up just a little bit with the 50, and we're turning up barely with the 200. Where the Stochk RSI, the Williams percent are, the CCI 14 and 20 are still all extreme positive. They could still go further up, and you could see that as good momentum, although there really wasn't any momentum in Friday's session, which again, you could take as positive, meaning we didn't see a lot of selling. I was watching for maybe a gap up after the economic reports came out. And then if we had really gapped higher, then you see selling into strength, and that could have led to more of a decline. But since we had pretty much a flat open, we just kind of kept going flat line for most of the day. And then the force index is still positive, even though it has been declining. It's no longer extreme. All of our stochastics charts in the short-term, intermediate short-term, and long short-term are still extreme positive. We're still up here at the upper end of the +3 channel for the standard deviations chart. The boom indicator based on 20 periods is still extreme. We're flattening out, but still showing some improvement with the 50 as well as the 200. Intermediate term charts, we're still extreme positive with the balance of power, even though it ticked down a bit. The CMB composite's been just camped up here in extreme positive land for most of the week. The go-no-go system still remains positive with the darker blue bars, and we're still at the upper end of the highest high value here, and the midpoint continues to go up. That's still positive. The TTM squeeze is getting even more extreme positive now. So we look at it longer term, and sometimes this can be kind of a significant event. We might see a reversal or at least a slowdown when we see a really extreme positive reading with this indicator. The ease of movement is rolling over a bit, but is still above 0. That's positive. The Arun is flattening out, shows the green line on top and the red line down below. So that's why the oscillator is above 0. We're getting just barely extreme positive with the S&P McClellan oscillator. And the summation index based on price is now crossing above 0. That's positive. We've been above zero and advancing based on volume. Looking at a broader measure of the NYSE summation index, we're advancing based on price and volume. And now this is another little warning sign here. We'll have to see if there's any follow through. We're starting to turn down a little bit with the Swenlin trading oscillator based on price, but we're just rolling over a little bit with the volume indicator. So these are not necessarily confirming each other. But on a momentum basis, the PMO is still positive, and we see that as well based on price and volume. With the PMO studies, we're still extreme positive with the PMOs that are rising. We're extreme with the buy signals, and we're also looking more positive with the PMOs above zero. We remain neutral with the Elder's Impulse system for the S&P with the blue bars, but we're still positive with the parabolic SAR, the slope, which is our short-term oscillator. It just keeps going up, and we're wondering if that's going to get to an extreme reading, but we're still looking more positive with the MACD. That's intermediate term. So we look at all of our oscillators. You can see we haven't had this high of a reading in the last year or so. We're still looking positive with the TSI. The intermediate term oscillators with the MACD, the PMO, and the PPO are positive. Longer term, we're also positive with the TRIX and KST. The Sean trend meter has not really crossed over this red line yet where we start to get extreme positive, but for right now, it's just maintaining a positive stance here. We're above all the plotted moving averages in our moving average tree. And this is kind of one of those sneaky things that's keeping the market more positive. We're still continuing to advance with the bullish percent index for the S&P 500. We're also showing a little bit of an improvement with the NYSE bullish percent index, and we're getting extreme positive and staying there now with the NASDAQ 100 bullish percent index. The Chaikin oscillator ticked up a bit and is still above zero. That's positive. The money flow is still extreme positive. The ultimate oscillator is flattening out, but still giving us a pretty high positive reading. The vortex is starting to cross even further above this red line, suggesting that maybe we're a little overextended. The RSI based on 14 periods is not extreme yet and still holding up, where the RSI 9 is still extreme positive. On-balance volume continues to go up, and we're above an advancing moving average. We saw a little bit of an improvement with our 200-period moving average study for the S&P 500 stocks and a little bit of a tick up with the 50-period moving average study. The Copic curve is also continuing to be positive. We look at that in a longer context here, where this is pretty much the highest reading we've had in 2023. We have had higher readings, and we're wondering, are we starting to get extreme with this indicator? The Pring bottom fisher, which generated a signal, even though it wasn't a real strong signal, that continues to hold up. And then I don't have any Fibonacci charts, and I'm just going to show the trend line study here. Just we're well above this downward sloping green trend line, and we're above this longer term trend line now as we're repairing some damage that had been done. Our different charts are positive across the board with the Heiken Ashi. We're positive with the Kegi, the Renko, and the 3-line break. Our longer-term charts, the daily special K is still going above the red line. That's a long-term positive signal, and the fact that this is crossing over is longer-term positive. We're also hanging in there with our longer-term moving average study with the 150 and 200. We're above this 250 level, which I call the midpoint, and we're still above this longer-term trend line going back to 2009. We're underperforming with the equal weight index. That's in red, but it was up. It would be nice if it could actually get to the point where it's outperforming the weighted S&P 500. And we're coming down just a little bit with our ratio. Doesn't mean that everything's falling apart. It just means that the broad market had a better day than the mega caps. We turned down a little bit with the Dow. We went up a little bit with the transports, and we were up with utilities. But the transports continued to underperform the Dow. And we're seeing this ratio going down just a little bit, meaning the transports are slightly outperforming the Dow, at least in Friday's session. But we want to see this really start to go down and stay going down. This is showing a little bit of an improvement as well. The ratio between the transports and the S&P, it ticked up just a little bit, but we want to see this going back up. In a healthier environment, the transports should outperform the S&P 500. The Dow is still having a hard time getting above this R2 pivot level, but it's still above its 50 and 200-day moving averages. It looks like we have avoided a death cross, but we remain neutral with the diamonds. The NASDAQ also having a really difficult time getting above this R2 level, but we're above the 61.8% retracement level. We haven't fallen down below that, at least yet. And we're still having a difficult time with the NASDAQ 100 getting through this R2 level. So we're hitting some overhead resistance based on the pivot levels that we know before the market even opens. We remain neutral with the QQQs for the Elders Impulse system. We're still looking okay with a momentum with the NASDAQ 100 for right now. We're above zero and advancing. The small caps were up on the day, but they were not able to get back above their 200-day moving averages or average. We're starting to turn back up a little bit with the RSI when we look at the Russell 2000 small cap index. So that's still positive. Longer term, though, we're working off of a death cross, even though we saw a bounce in Friday's session. But on a shorter term momentum basis, the small caps continue to be positive. We switch back over to green for the small caps with the Elders Impulse system. And we're coming right back up to the 200-day moving average with the mid cap. So this is providing overhead resistance. And we switch back over to positive with the mid caps for the Elders Impulse system. The financial sector, it looks like we could be getting rid of this death cross here. We're staying above the 50 and 200-day moving averages, and that's showing some improvement. Hardly a lot of the damage still that has been done has not been repaired, but this is showing some improvement. The micro caps were able to get back above this green line, which is above 100. That's a slight improvement. The FANG index was up just a little bit, but is above the 50-period moving average and still in a longer-term uptrend. And we're wondering, are we going to come back and test this previous all-time high? We've not been able to get up to that point yet. The dollar still continues to be in an uptrend, even though it was down almost 0.5% in Friday's session. Keeping an eye on interest rates, we were virtually unchanged with the 10-year yield, so we were also virtually unchanged based on price. This is one of these anomaly things. When we take the 1-month yield and then subtract the 3-month yield, because the 3-month is further out, we should always get a negative answer. We're getting a plus 0.2 here. Is that some kind of weird thing going on? When we really gyrated around, that was back last spring when they were worried about the whole debt ceiling crisis. Well, we're wondering, they already passed a continuing resolution to keep the government going, but why is this giving us a positive sign? We'll just see. Is that going to continue or just be a one-day wonder? An update of our possible positive scenarios. The Qs are still doing okay compared to the S&P. They're still above the moving average. We're coming right back down to the moving average with discretionary to the S&P, and we tick down just a little bit, but still above the moving average when we look at large cap growth to large cap value. So the large caps are still looking fairly strong. We're coming down with the mid caps. We saw a little bit of a bounce with the small caps. And we haven't got to an extreme positive reading with our 10-day average of the S&P highs minus the lows. If we get into this area, remember there's two ways to look at this. We could be overextended to the upside or look at that really good momentum because we can camp out in this area for quite some time. We're still negative when we look at the highs minus the lows and take a 5-period moving average across the Amex, NASDAQ, and NYSE. We are showing some improvement, but we want to be able to get above zero. That would suggest the broader market is turning more positive. And we're just about at the point now where we're crossing above zero with our new highs, new lows study based on 50 periods. This is longer term positive because the black line has been staying above the zero line. That's turning the red line, which is the moving average that we used on the previous chart. That is turning it just slightly back above zero. We're looking at the 2-year yield where it's continuing to come down. Sometimes when this spikes and really starts to drop, that can give a good support in the short to intermediate term for the S&P 500. And we're still declining with the Staples S&P 500 ratio, which often gives good support to the S&P. We're still looking positive with our 19-day exponential moving average of the advanced decline ratio. We're above zero based on price as well as volume. And here's the 10 to the 5 where it's dropped back down to being inverted again, just barely, but it's inverted. Tom Bowley's research, we're kind of in this point now where sometimes we see some weakness in November before we tend to see some strength going into the latter part of November. So what's our outlook for Monday? Still dealing with earnings season as they are released, still worried about this whole situation in Israel. Geopolitical, is there going to be more bombings over the weekend in Syria that the U.S. has been doing? And just wondering if there's going to be an overall escalation. The technicals, I haven't changed this. They're still positive, but we're looking extreme positive, or you could say overbought. We'll get LEI, the leading economic index. That'll be coming out on Monday. And then keeping an eye on all the different geopolitical events. We have a pretty long list here, with Israel right now still being at the top of the list. Here's the economic calendar for the upcoming week. On Tuesday, we're going to get existing home sales, and that's when the FOMC meeting minutes will be released. That could be kind of influential. Then on Wednesday, we're going to get some reports that are usually released on Thursday. So we're going to get most of the reports coming out on Wednesday. The market will be closed on Thursday for Thanksgiving. We won't get any economic reports on Friday, and it will be an abbreviated session. Looking at the Stock Traders Almanac statistics, we're beyond options expiration now. Now we're coming into the week after, where we're up about 62% of the time, and we're down about 39% of the time. So that's a pretty positive historical week from 1980 to 2022. Looking at the day itself, November 20 is negative for the Dow, where we're neutral to negative with the S&P, and we're neutral to positive with the NASDAQ. So we run the whole gambit there. We will be on the 14th trading day of the month. When we look at the green dashed line, that's a pre-election year. We do tend to see some weakness on this day for the S&P. We're also seeing, though, positive seasonality, though, during a pre-election year when the current president is running for re-election. So November tends to be pretty solid. We're also seeing a solid time going back to 1950 in the month of November, and then following over into the month of December. We're also seeing a positive sign here with this other seasonal chart. And then here's another chart that shows that even though pre-election years have this reputation of always being up, they tend to outperform all of the other years. And I showed this first in yesterday's video. Here's the end of the year rally is here. This is according to Carson. This is a new chart where we're following the green line. That's what's been happening in 2023. Where if you look at the third year of a new president, because that's what the president is right now, we might see some weakness going into the early part of December, but then we tend to finish the year pretty strong. Then looking at the NASDAQ, where we're in the month of November, wondering if we're going to see some weakness. It hasn't really developed yet. Also, the green line, potentially some weakness for the S&P. So our scenarios, we're not going with the down scenario because our technicals were just too positive when we look at our charts. But we are overbought. If we do start to pull back, and it's really dangerous to kind of front run these things because you don't really have any confirmation with your charts. But if we do start to fall back and it picks up in volume and it really starts to go down, then we might entertain the idea of maybe switching more negative. But for right now, we're going with the up or positive scenario because that's what all of our charts are telling us. But also be aware, we're coming into a holiday. We saw low volume on Friday. Is that going to carry over into next week? That could put the market in a pretty comatose situation, or it could really start ripping like we saw back in 2018 on Christmas Eve when we saw a real downward move. You have to just kind of be prepared for everything at the same time. And we're not going with the sideways trend because our ADX indicators suggest that we are in a trend, and that trend is getting stronger, and that trend is positive. The warning signs, our longer-term equity put call ratio is still going up. The risk-on posture, yeah, it's showing some improvement, but longer-term, it's still going down. Our 50-period exponential moving average study is improving and just possibly getting ready to cross above zero with a more definitive reading. The Russell, the small caps, and the mid caps are still working off of recent death crosses. The financial sector, it hasn't officially generated a golden cross yet, but price is still above its 50 and 200-day simple moving averages. The positive signs are daily special K chart. That's longer-term positive. I'll be going over the weekly chart in the weekly video. On a momentum basis for the S&P and NASDAQ, we are still positive. Our 5-period equity put call ratio is going down. That's positive for the S&P. The parabolic SAR and the vortex, they're positive. But with the vortex, we might be getting extreme positive. The bullish percent index continues to advance, and that's positive. Small and mid-cap growth, even though it's chopping sideways, is still positive in the longer term. So our conclusion, we're positive but overbought. This is the same as what I did for Friday's session. We can say the same thing with the short term and intermediate term, where we're still positive in the long term. Thank you. I hope you found this helpful. I will be putting out the other videos over the weekend. That'll be a weekly video, an intermarket analysis video, and then my last video will be the deep dive video. I hope you have a great weekend, and I will talk to you in the next video.